Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
It is Bloomberg Businessweek. We're watching shares of Netflix down 2% in the after hours. The company reported streaming paid net change for the second quarter that beat the average analyst estimate. But I think what has investors concerned, Carol, is the outlook and the third quarter forecast. The company seeing revenue at $9.73 billion. That's just shy of estimates of $9.83 billion, though it does see EPS coming in above estimates at $5.10 versus estimates of $4.74.
Yeah, I really get a feel that investors are trying to make a little sense as the stock's been bouncing. It's been lower in the aftermarket, but bouncing around at different times. Let's get to it. Let's make sense of it. Back with us, so grateful to have Bloomberg Intelligence Technology and Media Analyst Geetha Ranganathan and also Bloomberg News earnings reporter Red Brown. Geetha, to you, that number, I know you guys were looking for about 5 million on subscribers. They easily blew that out of the water. It seems like everybody's estimates.
Oh, absolutely. Complete blowout, crushed it. 65% higher than obviously what consensus was expecting. So the subscriber momentum is very, very much intact. And you're absolutely right there, Carol, about the guidance being a little bit tepid, and I think that is what is kind of weighing on the stocks at this point of time.
Are you worried by that guidance? Forgive me, Tim. Are you worried about that guidance?
Yeah, because this is where it's getting really, really hard to kind of model out this company. Remember, they're going to stop reporting subscriber metrics altogether. They're going to stop reporting that average revenue per user metric altogether in a few quarters. And so it's kind of becoming hard to figure out all of the different puts and takes. So we were kind of expecting 15% revenue growth in the third quarter. That's obviously a little bit light. They point to, Argentina being a source of the weakness. But then going forward, as more and more, subscriber growth comes from emerging markets, comes from some of these other, developing countries, is that really going to weigh on revenue growth? I think that becomes the big question. And then the other thing, of course, as you had pointed out earlier, was that they are not expecting a meaningful acceleration in the ad business in 2024 or even in 2025. And I think that'll give investors some pause as well.
What's interesting, though, is that even though revenue, Geetha, is coming in below estimates for the third quarter forecast, we're seeing the company at least tell us it's going to be more efficient because earnings per share is going to be $5.10. That beats estimates. An operating margin significantly higher than the 25.7% analysts had expected, coming in at 28.1%. So what's happening to Netflix where revenue is going down but efficiency is going up?
Efficiency is going up big time. And this is really, we've been talking about the operating leverage in this model, Tim, for such a long time right now. And this is that operating leverage that we get to see. They are giving that to us in the margin guide. Remember, they had first predicted 24% operating margin for the whole of 2024. They took that up to 25% last quarter, now up to 26%. That's a 500 basis point increase from last year. So, very, very likely that we can see up to 30% margins, maybe even as early as next year. This is huge in terms of just, what the streaming models unit economics are, how they're shaping up, just because there's been so many questions about whether it could ever be profitable and whether it could ever generate those 30% margins that the pay TV bundle was generating. And obviously we have a resounding yes with this report from Netflix.
Which is why, as you said earlier, kind of Netflix stands alone and is the one to beat. Red Brown, I want to bring you into it. Also, listening to Geetha and going through the numbers, what stands out for you?
Yeah, I think it's just kind of this confluence of the revenue drivers that we're kind of looking to pay dividends. When they say don't look at our subscriber numbers anymore, we're all saying, okay, we won't. We'll look at the revenue growth, and they're not kind of painting as pretty as a picture, I think, as the market would like to see for the time being. Maybe that does raise some questions on where is the levers that they can still pull to hit the numbers that everyone was expecting them to do.
Red, on the content side, what sticks out to you? Because the company did call out Bridgerton Season 3, Baby Reindeer, which I heard was really good. I haven't seen that.
I didn't watch Baby Reindeer. Bridgerton, yes. Queen
of Tears, The Great Indian Kapil Show, Under Paris Atlas, Hitman. Oh, I have heard of Hitman. I'm like, so many of these I'm reading, I'm like, these are not on my radar at all. The Roast of Tom Brady, though, that was one that everybody watched, it felt like.
Yeah, I mean,
except for Paul Brennan, who's just shaking his head in there. Oh, he watched it. Okay, he did watch it. Thumbs up. Two thumbs up.
All right. Well, if Paul watched it, then it must have been good. I think you are pointing to something interesting there. Is that the live? I think the thing that generated the most content, not on Netflix, but the most buzz was the live roast of Tom Brady. So I was reading some analyst notes that kind of called the content besides that a little bit lackluster this last quarter.
Huh.
So maybe that is, again, kind of pointing to the direction that they need to be heading is the live entertainment because it seems like if they're still attracting people with the content that they are, but it's, we don't get to speak to every subscriber, be like, did you sign up because it was live TV or because it was Bridgerton, right? So remains to be seen, I guess.
Geetha, I want to go back to you earlier when we talked to you to preview what Netflix, you talked about Netflix having the durable advantage over the long term. I look at, part of, I guess they have that durable advantage is I think about the cash that they generate. Talk about cash flow and what we got from Netflix on that front.
So cash flow still continues to be really, really strong, Carol. So they're still guiding to $6 billion in cash flow this year. And remember, they had generated about $6.5 billion last year. But the reason we're seeing a little bit of lumpiness this year is because of all the strikes that happened last year, and so much of production kind of got pushed to this year. But the real metric that we should be looking for is, the 2025 free cash flow. And I'm thinking just with the kind of profitability and the operating margins that they reported, we could easily be seeing about $10 billion in free cash flow going to next year. And that now gives them a lot of flexibility. They could invest in more content, of course, but it also gives them flexibility to do buybacks. And that, again, it becomes then your EPS booster over the long term.
They did say in the release during the second quarter, we repurchased 2.6 million shares for $1.6 billion. We have $5 billion remaining under our existing authorization. So I guess stay tuned to see whether or not we see more. What's the number one question you would be asking Netflix on the call here, Geetha?
I think a lot of concerns are still going to center around the advertising business. So I think we definitely want more clarity on that. Yes, they did give some perspective in terms of how many new signups came, but they still haven't actually given us a number in terms of how many number of subscribers are on the ad tier or what is the revenue that they're generating. I mean, they say it's not, it's de minimis, but still, I think we would definitely like to have a little bit more clarity on that.
Red, I want to bring you back in. You watch the earnings, you watch the market. Certainly for us, I mean, Netflix is a big one when we think about the earnings season. We're just getting kind of started. But how are you thinking about it in terms of maybe what it means for some of the other players?
Yeah, I mean, it's the first tech name, really prominent tech name that we're getting. I guess we'll have to wait and see kind of how things shake out here with the market reaction. I mean, it's not as bad as I guess it could be. I think there's definitely some areas of optimism, I think, to take away from this. The fact that they did add more subscribers than were expected. They did it across all of their regions, even with some of that weakness that they're pulling out in Latin America. I think that still speaks to maybe some strength for the tech companies that are a little bit more consumer facing to maybe have a decent earnings season still here.
Hey, Geetha, on page 3 of the earnings release, they talk about engagement and competition, and there's this donut chart that shows that streaming now accounts for 40% of U.S. TV screen time. Still, broadcast and cable account for more than 40% together. Netflix and YouTube, though, are the clear leaders when it comes here. Everyone else, they kind of leave in the dust. That's according to Nielsen. Who are they going to pull more share from, or who do they need to pull more share from? Is it competition, or is it the traditional cable and broadcast?
It's a little bit of everybody. So, clearly we're seeing cord cutting. I mean, we've already seen 30 million subscribers leave the pay TV ecosystem. Where have they gone? Well, they've gone to Netflix, they've gone to Amazon Prime, they've gone to all of these other streaming services. But what is going to happen is, as all the competing services and Netflix raise prices, people are going to have to make a choice. And they are going to make that choice. And we think that default choice is going to be Netflix. So we're going to see their share kind of increase from the current 8% or 9% that it is and go higher, not only because people are moving from linear to streaming, but also moving within streaming and gravitating more towards Netflix and YouTube.
All right, Geetha, 10 seconds left here. This is a strong report, good report. How do you describe it?
I would say definitely a very strong report. In terms of subscriber momentum, they've kind of checked all the boxes here.
All right, gonna run. Hey, Geetha, thank you so much. Of our Bloomberg Intelligence team and, of course, our Bloomberg News earnings reporter, Red Brown.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Already, though, on our radar, the ADRs of Novartis that trade here in the United States, dropping the most in more than 3 years. This is after sales of the company's closely watched prostate cancer drug disappointed in the latest quarter, taking the shine off a raised profit forecast from the Swiss pharma company. Novartis shares falling as much as about 3% in trading that we've seen, trimming this year's gains to about 14% after sales of the treatment fell short of analyst estimates. A lot to unpack here. So let's get to it with Vas Narasimhan. He is CEO of Novartis, joining us from the company's U.S. headquarters in East Hanover, New Jersey. Vas, great to have you here on Bloomberg. Let's talk about the quarter. You reported profit. That beat expectations. You raised your forecast. Your shares are down. As we mentioned, we hear in the market that there are concerns about how long your growth driver drugs will keep delivering. Why do you think that you're having a hard time winning the market over?
Yeah, look, I think first it's really important to take a step back and see how well we've done over the recent years. When you look at our shares over a 5, 3 year, and even year to date, we're really in a place now where we've been trending at all-time highs. So really today we've just given back a little bit of what we gained in the recent weeks, but still trading really near all-time highs for the company. I think really demonstrating that investors are recognizing the outstanding performance we've had as we've, after $100 billion of transactions, focused into an innovative medicines pure play company. That's allowed us to drive our sales growth in a dynamic way, increase our profit guidance today to even higher levels. And we feel really good now about the trajectory of the company coming out of the quarter. When you look at it, in the next 5 years, we've committed to grow 5% plus, and we have the growth drivers in hand to deliver that. We also have committed to be a 40% margin plus company, and we're already at 40% margin today. So we're delivering against what we said we're going to do. Mm-hmm. Now, I think one of the things we learned today is it's just really important that every one of these growth drivers hit their targets. Pluvicto's a little bit behind, but we believe that in the long run, we're on the right trajectory. This will be a multi-billion-dollar drug. And more importantly for us, radioligand therapy, this whole class of medicines we're working on, can be a significant $15, $20 billion area that we can build over time.
Pluvicto, let's just go there because that seems to be what maybe is putting so much pressure on the share price. The ADR is down more than 4% as we speak. That is your prostate cancer drug. You seem to have reined in some of the optimism over it. The CFO telling reporters this morning that the next dynamic boost in sales probably won't come until the drug tests a broader label. So I am curious, are you guys reining in the optimism? What are you doing to rein in not to rein in, but to win over physicians to that medicine in particular?
We're certainly not reining in our optimism on Pluvicto. I think what we're trying to articulate is right now we're on a run rate, if you look at it in the U.S., of around 1.2, 1.3 billion. We're going to add a couple of $100 million overseas. And we always knew in this first indication we were going to reach a max of around $2 billion. Now, the speed at which we're going to get that ramp is a little bit slower than what we've expected from that 1.4, 1.5 level up to the $2 billion level. It may take us a little bit longer, mostly because in the U.S. now we have to get this medicine more broadly available with community oncology, which will take us some time. We're making those steps. We have over 450 centers now providing the medicine. Mm-hmm. But what that's really importantly going to do is build the base, which allows us, when we triple the size of the population we can address next year, we hope with the approval of our next indication, we'll see another ramp in the sales, again, towards a multi-billion-dollar medicine that we think will drive our growth through this decade and into the next decade. So I think we just want to be realistic that getting to that next phase in our first indication is going to take time because we have to get into the community. But once we do that, we'll have built the foundation for all our future launches with radioligand therapies.
Okay, well, speaking of the next phase, let's talk about Kisqali, the breast cancer drug for early breast cancer, because analysts have pointed to a 3-month delay in FDA approval for it. So how confident are you, Vas, that you'll win this approval in the second half for a broad group of patients?
We're very confident. I mean, right now with the FDA, we've submitted some manufacturing adjustments that we agreed that we needed to make. We've submitted the stability data, which they always ask for when you make manufacturing changes. And we had a 3-month clock extension. Now, it's important to note with Kisqali, we were already on what's called a priority review timeline. So now we've added 3 months. All it does is put Kisqali back into a normal drug approval timeline. And we believe we're not only going to get the approval, but everything that we've seen suggests we will get the broad label. And I think importantly, what we announced this morning is we've seen now longer follow-up data that continues to show the positive impact Kisqali is having for patients of all subtypes of early breast cancer, along with an outstanding safety profile. So we believe this will be a very significant medicine. We've guided to $4 billion plus in the metastatic setting, $3 billion plus in the early breast cancer setting. So at least $7 billion. And certainly, if we continue to see the data evolve as nicely as it has, it could be much bigger than that. So we're really excited about it. We're going to get that approval, we hope, in Q3, and then we'll take it from there.
All right, you know better than most how everybody's so into the GLP-1 diet drugs. And you did mention on the analyst call that Novartis is working on a next generation obesity project, not advanced yet to patient trials yet. Are you willing to do, Nas, maybe a significant deal to a more advanced pipeline in this area, maybe to give Novartis a more competitive position? Roche did one last fall. It looks like it was a pretty smart move. Roche did very well yesterday and kind of awakened the market once again for the diet drugs. What about you guys and your strategy?
Yeah, we've looked really closely at this. I mean, we've been in cardiovascular disease for many decades, really one of the largest cardiovascular medicines companies in the world consistently over time. And our view is that the current wave of therapies, there are many companies out there. You have 2 very large incumbents that are already doing well, a number of companies chasing them on the injectable GLP-1 or GLP-1 combinations. And then you have oral drugs, and you have a number of companies with oral GLP-1s. You know, in my experience, that when you have situations where it looks to be relatively easy for many companies to come into space, you're going to get payer pressure. You're going to get very difficult competitive dynamics. You're going to get rebate dynamics, particularly in the U.S. And so when we looked at that, and when we look at these deals, we think to play the long game and actually say, where can we bring really differentiated medicines that could hopefully add something new, less frequent dosing, maybe a better tolerability profile, maybe better muscle sparing attributes. And so that's where we've decided to focus our energy. I'm sure you will hear every month on your broadcast about another GLP-1 or another oral GLP-1 or GIP-1 that's come out. But that's really indicating that this market is getting extremely crowded. And I think in our sector, the companies that win are the ones that find differentiated positions with really important medicines that can replace the standard of care. And that's where we're focusing our energy.
But what would you say to investors who may say that you're missing out right now on something that is obviously turning out to be pretty huge, and that, you know, sooner than later would be better to get a competitor in the space?
Yeah, I think when you look at it, most of the drugs we talk about, even the ones that have been recently in the news, are going to be launching at the end of this decade. So I think you have to separate investor reaction to the realities of launching medicines in our industry and developing them. And so, I would say I think most long-run investors who understand our sector would know it's prudent to think about what is the world going to look like in 2029, 2030, 2031, when a medicine that's in phase 1 finally comes to market. And ask yourself, what would put you in a position to win at that point in time? And that's the strategy, we're thinking here. It's easy we've had it in the past with immuno-oncology. And that time we piled in, we did a number of deals in immuno-oncology. That didn't work out so well. And I wonder also, when you do that, do you crowd out other innovation within your R&D portfolio? So rather focus on places where we have differentiation, we can win, rather than being now what might be the 4th or 5th or 6th oral obesity first class drug, or maybe the 7th or 8th injectable drug. I don't think that's a good use of our capital.
Nas, you made some mention to what the world, kind of looks like going forward. And I am curious, your CFO on the call post earnings did talk about U.S.-China relations and, no matter what the political scenarios are, what do you think the environment looks like for big pharma, the business environment post the November U.S. presidential elections? Does it matter who is in the White House? And just got about a minute here.
Yeah, I think first, we're we're not taking sides with respect to the election. Most importantly, we need better policies in the United States to support innovation and support patient access. We think the IRA is a flawed policy for at least the healthcare portions. We need to fix 9 to 13. We need to keep addressing out-of-pocket by fixing the PBM situation, fixing other legislative areas like the 340B program. That's on the U.S. side, and hopefully whichever administration and constellation of government is there takes that head on to create the right innovation ecosystem for the long run. And then I think we're obviously want free trade. We believe our ability to provide medicines around the globe is absolutely critical. China is a very important market for us. We grow double digit, but also Japan and Europe. And so we're hopeful that we can keep shaping policies that recognize that ours is a very global industry. Healthcare is a global area, and we need policies that enable us to work freely around the globe to bring our medicines to as many patients as possible.
Vas, so appreciate your time today. Thank you so much. Really appreciate it. Vas Narasimhan, he's the CEO of Novartis, joining us from their headquarters in the United States in East Hanover, New Jersey.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We also, folks, had an IPO today. Ardent Health Partners began trading around 12:38 p.m. Wall Street time. The stock opening at $15 a share. It was a red sticky, I think, on the Bloomberg, opening at $15 a share. It was below its IPO price. Just some numbers for you. The company raising $192 million in that IPO, shrinking the size of the share sale, pricing it below a marketed range. So selling 12 million shares for $16 each. This was yesterday. They had marketed about 14.3 million shares for 20 to 22 apiece. I'm looking at the stock. It is lower in the trade, but we're looking at a market cap, Tim, of about $2.2 billion.
Okay, so let's get more on the business, on the outlook, and of course the IPO with the president and CEO of Ardent Health, owner of 30 hospitals in 8 markets, 6 different states, and many more sites of care, a couple hundred of them actually. We got Marty Botnick here in our studio. Marty, good to have you. First of all, congratulations on the IPO. This day, a long time coming for you and the team.
Thank you. I'm delighted to be here, and it's an exciting day for our company, and most importantly, the 24,000 team members we have caring for patients across the United States. So it's a great day. Thank you.
Carol mentioned the reception. Not ideal on an IPO day when you see a share price fall when it starts to trade.
The market is down overall.
Yeah, to be fair, the market is down overall. But give us your thoughts around that and the way that it's been received, at least on the first day.
Yeah, no, we're really excited about the future of this company. We've got a strong balance sheet, modest leverage, and a strong growth profile that we're confident in the future in. And so this is something that, this is a long journey. I'm an endurance athlete, and I tell my team all the time that this is a marathon, not a sprint, and any one day is not going to make or break our training. And that's how we think this. This is the starting point of a new journey for this company.
Well, speaking about endurance, right? The second time you guys filed for IPO, did it in 2018, you withdrew in 2020. Was it much better market conditions to do it now?
Well, we've been preparing for this for years, and I don't believe you can ever time the market. That's not what we were trying to do. We've got a great company that's poised for growth, and so we were really making sure that we can come out of the market as a strong public company. And we know that the performance and the growth trajectory we have is going to set us up for the future.
So the market conditions had nothing to do with it?
No, we really see tapping the IPO market as a currency for our future growth, and that's what we're focused on.
There have only been 5 healthcare services IPOs so far this year, including yours. So there aren't that many of them. Why is now the right time to go public? And also, how do you differentiate yourself out there?
Yeah, so for us, we always said we'll go public when we're ready, and we are ready. Our team has been working relentlessly to prepare for this moment. We're going to be a strong public company. And we said we'll go ready when it's time for us to grow. And we know that the markets right now are ripe. We've got a lot of inbound interest based upon the joint venture partnerships and the markets that we're in to continue to build. And we've got multiple growth strategies to do that.
Marty, talk about the markets you're in. What is the strategy? Because my understanding is you're very much in acute care, mid-sized urban markets, growing populations. Explain kind of the thesis for the growth trajectory.
Yeah, we operate in mid-sized urban communities, and we go really deep into those communities. Hospitals are obviously the front door of what people see, but every day we see 20 times more patients in our outpatient clinics than we do our hospitals. And so we really believe in building an ecosystem of care around the person the patient as a person and a consumer. They have choice. And so not everybody has to come to the hospital for care. We want to have an ecosystem that provides for that care wherever and however they need it.
Explain that a little bit more. The reason we are, I want to ask that. Tim and I had a great conversation with a doctor at a public hospital, I should say, in San Francisco, and talked a lot about the pressure on doctors in the medical community to kind of get through their patients quickly. And as a result, they're not talking to their patients. What does it mean when you say you want to develop the care around a patient when we've all experienced in, out? I can't even get appointments that doctors are like, well, call me back in 6 months, or how about an appointment in 6 months? How do you develop care around a patient when there's a lot of stress points right now?
Yeah, no, it's a great question. I'll give you a personal anecdote. I was training for an Ironman, and I got hit by a car. So I got to be a patient for the first time.
Running or cycling?
Cycling.
Okay.
Wow. Okay.
And so I got to be a patient for the first time, probably in my career outside of a clinic visit or something. And what I realized is we have really great caregivers in this industry, and we have challenging systems and processes. And this industry hasn't always catered to people's input or their money or their time. And so at Ardent, putting the patient at the center of everything that we do has become our North Star. And so we're creating that ecosystem that we want to embrace technology to make it easier for our caregivers to deliver care to those patients and safer and more effective for patients to receive it. So that is a really big portion of our strategy and how we go at it.
How do you do it? And then as a publicly held company where Tim and I and everybody's going to be watching those quarterly reports, how do you balance making sure you provide that care and really put the patient first, but also you've got to be a profitable company, and we're all watching?
Well, I mean, having great people is the start of it, and our chief medical officer always says, creating good process workflows lead to good clinical outcomes, which lead to good financial outcomes. I've been doing this for over 25 years, and what I've always said is that if we take care of the patient, provide good service, good quality, good safety, the finances will follow, and that's what we've seen.
I want to go back to that anecdote that you shared about becoming a patient, because obviously we're glad that that wasn't a worse outcome, because that can be really bad when a cyclist is hit by a car, obviously. But how did that specifically change the way that you're doing business? Like, what changes did you make as a result of becoming a patient?
Yeah, I told that story, which we don't have time to get into, to our entire leadership. And I said, this is an opportunity. My wife said, God gave me a second chance to be here and do something with that. And so whether it was ban the clipboards in terms of making it easier for patients to get into our clinics, focusing on technology that, again, is going to allow our nurses to be able to provide more effective care. We're not immune from the headwinds that this industry has faced. There's been a lot of turnover in nursing, physician burnout issues that you were talking about, Carol.
Yeah.
Yes. And so we are just embracing technology to make that easier for our consumers. We think about it. I can control my whole world from my iPhone, no matter where I'm at. But in healthcare, it's always been a challenge.
It's not necessarily HIPAA compliant.
Yeah, well, you call somebody, you go through a phone tree, you get disconnected or rerouted. So we want to make it easy for people to access our system.
They're still using faxes to send and CD-ROMs for MRIs, for example.
And so we've introduced virtual nursing, bringing more nurses to the bedside to help take care of the more detailed, cumbersome, time-consuming tasks, so our nurses at the bedside can go and address acute emergencies for the patient. And so being very thoughtful and methodical about how we are embracing technology, supporting our team members, and creating good retention. That's what this is about.
What do you do with the IPO proceeds? What's the focus for a lot of investing going forward right now?
Yeah, no, we are a company that's poised for growth. We have built a scalable platform that we know is in demand. That there's still a lot of hospitals struggling. We've had a lot of inbound interest in terms of expanding our footprint. And so these proceeds are to help fuel the next round of growth as we grow into new communities and continue to invest in the communities that we're in today.
Equity Group Investments is the majority owner, or an affiliate of Equity Group Investments, I should say. And they're going to continue to hold the majority shareholder voting power. Just very briefly, 20 seconds. Does that give you more freedom, or does it constrain you?
Equity Group has been a great partner. They've been part of us for 9 years. And for this audience, which I know Sam Zell, I wish he could have been here to celebrate with us today. This would have been his 14th company that went public. He had that vision for us. And so they're a great partner and will continue to see us grow. We've doubled the size of the company since they've been a part of us, and we're going to continue on that trajectory.
All right, going to leave it on that note. Look forward to hearing more in the future. Thank you so much for coming in. The President and CEO of Ardent Health, Marty Botnick, joining us in studio. As we mentioned, an IPO today. It's first day of trading, stock down right now just about 2.5%. We'll continue to track it into the close.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
You know, our focus is certainly the RNC. Donald Trump is set to address his party tonight for the first time since officially becoming the presidential nominee and surviving an assassination attempt with a speech aimed at uniting Republicans in his campaign to defeat President Joe Biden.
Meantime, President Biden faces a growing drumbeat of calls from lawmakers for him to stand aside, with the Washington Post reporting today that former President Barack Obama has told allies that Biden needs to consider his viability as a candidate.
Margaret Talev is the director of Institute for Democracy, Journalism, and Citizenship at Syracuse University. She's been on the ground in Milwaukee. She is also a former colleague, senior White House correspondent for Bloomberg News, and contributes to Axios. She joins us from the RNC in Milwaukee. Margaret, so great to have you here with us. How are you?
Thanks. It's so great to be back home, as it were. I'm doing great, but this has been an exhausting week, as you can imagine. This seemed like sort of the most least action-filled election year for so many months. It was like, okay, we know Donald Trump, we know Joe Biden, we know the contours of this race. It's about turnout. What else could happen? That's every reporter's mistake. In the last 3 weeks, we've seen a complete turn of fortune. Donald Trump and his followers here at the convention feel that all the winds favor him now. And so you see a tremendous amount of almost jubilation and enthusiasm in the convention hall. At least these folks think it's now his race to lose.
Yeah, it's hard not to feel whipsawed. The headlines, it feels like over the last couple of weeks, changing very dramatically, post the debate with Joe Biden and a really tough showing there. And of course, the assassination attempt on Donald Trump. And then, of course, just the momentum that we're seeing at the RNC. Having said that, are you getting ready to be whipsawed again in terms of maybe Joe Biden stepping aside, at least for the next run here come November?
We might very well. I think we all need to be prepared for any contingency. What we're hearing here on the ground from folks around the former President Trump and his orbit, is that they don't think it makes any difference. They're running against the Biden administration and Democrats' record and the inflation and some of the other economic factors of the last few years. They think if it's not Biden, they're most likely to be running against Harris. And if they're running against Harris, they're running against Biden. They're saying that even if it were to be someone else, they think they would still run against the Biden record. But in reality, I think they have not really prepared for a different contest that is not against Joe Biden or Kamala Harris. So the next few days are going to be obviously very determinative, and nobody knows what's going to happen or when it's going to happen. And that is the only wild card, per se, at this convention. Vance, well received last night. I would say not jubilant, but the crowd liked him and was interested in his message. And I think outside of the convention hall, it's a message they are banking on that resonating in Rust Belt states.
That's so interesting to hear that. I want to go back to what you were saying about a potential change at the top of the ticket. What if there isn't a change at the top of the ticket? How does the nominating process move forward when there is so much division within the Democratic Party, at least in certain levels, and also when every little moment of the current president's day is sort of seized on for signs that he's not fit to run?
I think you're asking the question that a lot of journalists covering this race are asking, and that a lot of Democrats who have a vested interest in this race are asking. I mean, there are a few different ways that if President Biden decides that he's going to continue his reelection, but there's a few different ways that things could emerge. Either, number one, they could do a virtual nomination. There is a possibility that could happen as soon as next week, but it just doesn't feel like that's where the mood of Democratic delegates is now. He could be nominated at the convention, or there could be a challenge. So those are essentially the scenarios that all of the Trump campaign's planning is for a campaign to run against Joe Biden. So I don't think they're looking at switching it up, but I think even if Biden decides to stay in the race, his campaign is going to need to rethink the way they are messaging in the final weeks of the race, because right now the majority of the American public, and it seems that in some polling, majority of Democrats are not confident that he's best suited to carry on for the next 4 years.
Well, the presidential race is on, so is the messaging race. I'm looking at your election graph report that you guys have put out. More than 2,200 Facebook pages have run ads since last fall mentioning U.S. presidential candidates, collectively exceeding 1 billion impressions, billion with a B, as of the end of April. That's according to your analysis. But one of the things that you guys identified that is troubling is these inauthentic actors. Information versus misinformation, it is critical, especially when it comes to a presidential race.
Oh, that's right. I'm so glad you're into this project. I'd love to tell you a little bit about it. My institute at Syracuse University, which is focused on the connection between people's civic involvement, their trust in government, and their trust in the news, right? That's our sweet spot. Was very happy to be able to apply for and receive a grant from a company called Neo4j. If you have not heard of these guys, they're really interesting. They've been involved in everything from NASA projects and projects in London to that great reporting on the Panama Papers. And what they are is they are an analytics and graph database company. And if you think about spreadsheets or kind of old school research in terms of rows and columns, they allow you to see in sort of more of a 3D way the hidden connections between actors. And you can see patterns that are hard to uncover. My lead researcher, my colleague Jenny Stromer-Galley, and her team built these searches, these algorithms to look at messaging right now in paid ads on Facebook and Instagram. And that is what they found. A portion of these ads around the campaign involve inauthentic influencers. These are groups that seem like they're unique and different, but they really appear to just be shells of other groups. They're carrying the same, often misleading videos or texts. Some of them are spreading financial scams. And as social media platforms like Facebook seek to shut them down, there's another one under a slightly different name just ready to pop up and carry on. In some cases, these could be misleading voters about policy, and often they are. Sometimes they're just financial scams, and so they're taking advantage of people's interest in the presidential election in order to capture voluntarily their credit card information, their CVC code, and then they're getting bills for things they never thought they were authorizing. And so you really, it is really voter beware, because they're not just trying to manipulate your vote, they're just trying to take your money too. And that's not the majority of ads, but it's impossible to tell the difference when you're just online and trying to get information.
We only have about 40 seconds left, but I'm wondering if you think that the social media companies are doing enough.
The reason our research only looks at Facebook and Instagram is it's the only research we have access to. And my group is not an advocacy group. We don't lobby for anything. But I'll tell you, just as a journalist, I'm telling you, Congress needs to get much more involved in compelling these social media platforms, other ones, to make this kind of information available. If they truly want to stop it, it's impossible to stop it on their own if they don't, if the public and journalists and researchers don't also have access to do this sort of tracking.
I feel like journalists know this. We have to really understand our sources and where things are coming from. That's kind of journalism 101. But even as, voters, citizens, especially in a social media world where we get so much of our news from social media, you have to be really smart about understanding exactly where the source is. And that's true, certainly when it comes to political campaign messaging. Margaret, great to reconnect. Really appreciate your time today. Margaret Taleb, she is director of the Institute for Democracy, Journalism, and Citizenship at Syracuse University. And of course, former senior White House correspondent here at Bloomberg News, joining us from the RNC in Milwaukee.
I'm driving in my car, I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 18 minutes left in today's trading session on this Thursday, July 18th. Charlie just breaking down the numbers. We're just coming off our lows of the session, but it's definitely more of a risk trade, a risk-off trade, I should say. If I look at the S&P 500, though, if I pull it up on the Bloomberg, I've got, most names lower, 381 names to the downside, Tim, 120 gaining ground, 2 unchanged.
It's pretty amazing to see. Oh, thank you for turning on my microphone.
Turning on your
Carol.
mic.
What I was saying, it's pretty notable to see the broad-based decline today. Yeah. Also hitting the Russell 2000, as we just heard from Charlie. Let's see what Max Wasserman has to say about it. He's founder and senior portfolio manager at the RIA Miramar Capital. He joins us from Northbrook, Illinois. Max, how are you?
I'm doing well, thank you. How are you guys?
We're doing pretty well. Hey, we're going to get to your stock picks because you sent us. Thanks for sending us some really interesting companies to talk about in a second. But I want to talk big picture first because you argue that the haves are doing pretty well in our country, but the have-nots are not doing so well. Talk a little bit about that.
Well, when I say the haves, what the ability is to trade down, what we're seeing is people who have the resources are trading down in their picks. So they still have the ability, but inflation, high cost real estate is affecting their choices more. People who don't have that ability, they're really suffering more. I mean, if you only have $10 and inflation's higher, then it's hitting you harder than somebody who has $100 who has more flexibility. So what we're seeing is the people in the lower to middle class are being hit by the inflation, the rising cost, and their ability to navigate through this expensive inflationary environment is much harder than somebody who has much more discretionary income.
Always important to point out, and we have been saying, I feel like fairly regularly too, that we have to remember that our society, not everybody's in the stock market. A lot of people are not, and that Wall Street is not necessarily Main Street. Why are you, though, thinking that it's really important to make the point that you just did?
Well, I think what you just said. I mean, basically, the stock market, is reflecting financial assets and everything that goes into that. Federal fund policy, fiscal policy. But if you look at people who are living the day to day and they go to the grocery store, higher inflation, higher cost of goods, milk, gas, it affects their day to day and it makes tough choices. Where people, again, who have the ability. So if you look at where people are shopping, you look at, are they trading down? So you look at companies that can benefit from the change in consumer spending. So that's really the key thing, who has the money and who doesn't have the money. And what we're still seeing, even in this environment of the haves, the stock market is extremely well off right now. And I say extremely because you're still looking at an index about 17% up. So people who have money in 401ks, they're not feeling hurt. Even with any pullback in the market, they're feeling like they're doing well. But people who don't have money in the market, who have to go to the grocery store, who have to pump the gas, they're feeling inflation a lot more tangibly.
Interesting. Yeah. I mean, it's interesting that we're talking about this now, when inflation has come down, Max, then,
right.
And because we were talking a lot about this over the last 18 months, but the Fed is, I'm not going to say it's winning, but every person we talk to pretty much says there's going to be a soft landing, and the Fed chair is pretty confident that we will see inflation return to that target 2%. Why is this on your radar right now as we speak?
Well, I think what you're going to see is you're going to see a hiccup. You're always going to do it. There's no such thing as a pure smooth landing. It could be sparked by politics. It could be anything. But with these valuations levels at this high, at what we have right now, at the S&P, the NASDAQ, anything that hiccups this market is going to pull it back. But the reason I'm bringing that up is because everybody knows it, and everybody's been concentrating their investments in the top 7 technology stocks. Like, there's a big discrepancy between the S&P 500, which is cap weighted, and the equal weighted index of the S&P. And the general market itself has been struggling, but the market caps of these big, large tech companies have been doing extremely well. So when you listen to companies' reports, as I do, you listen to conference calls, you're seeing the majority of companies are being hurt by inflation. They're being hurt by the cost of goods, and that reflects the consumer. But the high tech has been immune for now.
Do you need to be, or should we be worried about the rotation? But what's interesting, even today, we've seen mega cap tech pulling back, but we've also, small caps were on a move to the upside, a rise, a little bit of a trend there, but we're seeing small caps financial shares also weighed down today. Concerns about economic weakness. Is there something, though, in the economic outlook that should make us start to be, as investors, a little bit more worried and concerned about some kind of economic downturn?
Well, I think there's two ways you look at it from the investors. From people who are relying on income, like fixed income or money markets. Right now, they're getting about 5% on short-term money markets. So if the economy were to slow down and the Fed cut interest rates, that's going to affect those people looking for what I call safe money market returns of 5%. So that could affect them. Although a rotation in the market is perfectly healthy. When you look at these valuations of these top tech, they're 37, 40 times earnings. When that money comes out, it's going back into companies that have been hit hard. You look at healthcare, you look at financials, you look at consumer staples. These stocks have already reflected this slowdown in the market. So when money comes into them, that creates opportunity. So if we look at risk reward in the market, we think you have better reward outside of technology than in the fact that you have technology.
So let's go there. Hershey is one of the names that you like. It's up 3% year to date. Tell us why Hershey.
Have you ever had a s'more?
Well,
come on, Carol. Why Hershey?
How do you not like s'mores?
Yeah.
All right. I got it.
You gotta love those.
What's the investment thesis beyond some more?
But we're dividend investors, so we're looking for companies that are mispriced, paying a good dividend. So right now it's paying about 2.8%. The average dividend increase over 5 years has been 12%. Traded roughly 20 times earnings. 5-year average is 23, and it's been hit by cocoa prices. So cocoa prices and inflation's been hurting them, but their organic growth is still 2 to 4%. So when I look at a company that's trading at a discount to its 5-year average, underlying growth is still there. It's paying me a growing dividend. The year high on the stock was roughly about 248. So I'm not buying it near the top. I'm actually buying it near the lower half where it's been trading. I think there's more upside, especially as inflation comes down. This company should benefit when it has organic growth already.
Okay, I want to get to one more. We only have about 40 seconds left, but you like defense stocks, including General Dynamics, up 13% so far this year, around $293 a share. Make your case for it.
Okay, look at 80% of it is defense and 20% is the Gulfstream. So 80% is the Stryker, the Abrams tanks, and the nuclear subs. So you look at China, you're looking at nuclear subs. You're looking at Eastern Europe, you're looking at the Stryker, you're looking at Abrams tanks, the Middle East. Then you got 20% of their business, the Gulfstream, is coming online with the new G700s, which would really help them benefit them. So we think it's a core defense company, and it has a cyclical kick with the airline industry, with the G7, 700, 800 series, which would really propel their earnings.
All right, going to leave it on that note. The stock, by the way, General Dynamics, up about 13% so far here in 2024. Max Wasserman, thank you so much, founder and senior portfolio manager at the registered investment advisor Miramar Capital, joining us from Northbrook, Illinois.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.